Now, in addition to that, one of the things that's been happening in the world of trading is the Warren line had also gone bullish at that stage. So Warren's been buying behind this pullback bottom edge here. And that's something that starts to form into the bottom print price. And a very, very nice pull away. Now, has it gone too far too fast? Well, we'll have to wait and see how it plays out this afternoon, but that's pretty obvious. Looking at it from the puts calls ratio, we can already recognize that part of the story of the bottom edge was this spike, correct? Is that not what we said? We drew a line through these spikes and we said, look guys, this is important. If we've got that much volume, that's an unwind. That unwind gives us the idea that if we're into a low price, that's going to be stock buyers. That's going to be the big funds buying the low prints down in these areas. And obviously the buy that's came from that has been fan-fucking-tastic. 70 points. 70 points on the S&P since that point. And that's the trade right there, guys. That's the deal. It's pretty good. So obviously you went from the Friday close and then the Monday. And like Paul said, the turnaround Tuesday was the big rally price. So turnaround Tuesday, right enough on this occasion. And obviously the takeaway from that is fantastic. Yep, the big volume is on the puts, Stuart. We don't get big volume on puts if people are buying them. You get big volume on puts when people are selling them. Okay, when people are selling them to close a position. Because they all come in at the same time. The exit door is fast, it's furious. And when you think about it, that's obvious. Because if you think about what you would do as a trader, if you were a big fund desk, right? You're sitting on Goldman's fund desk and you're saying to yourself, okay, let's watch this S&P rallying. Prices start moving up, prices are kicking off, and you start seeing a bit of sell pressure coming in. You start seeing a bit of sell pressure. What happens? Well, as you start to see a bit of sell pressure, I'm going to start buying some puts. I'm going to start buying some puts when it's cheap, because the volatility is cheap, the prices are going up. I'm going to start buying some put hedges coming into these areas, yeah? Put hedges coming into these areas, nice and quiet, slowly consistent, and all sorts of things. So what happens to the puts calls ratio? Well, nothing. Why? Because whilst I'm buying puts, I might be paying for those puts by selling calls. Why would I sell calls? Well, because if I'm buying puts, I can't be that bullish anymore. So if I sell calls, it makes sense, doesn't it? So I'm going to sell some out of the money calls. So I'm going to sell some calls up here. So I'm buying at the money puts, and I'm selling some out of the money calls. Selling some calls out of the money. Selling some calls out of the money. So in terms of volume, the volume is 1-to-1, correct? It's just volume. It doesn't matter whether you're buying or selling it. It's still just 1-to-1 volumes. You see that? 1-to-1 volumes. And then what happens? Well, obviously the trade then just collapses out of that position. And as it collapses, obviously all those long puts that I've now got, I close off my puts by selling puts at that stage. And it's all at one price, isn't it? It's not at several prices. It's literally a single price. So if I had 6 accumulation trades here, I get 1 trade here, 2 trades here, 3 trades here, 4 trades here, 5 trades here, 6 trades here. And what happens to the puts calls? Well, obviously now the ratio maybe jumps from that 1-to-1, and we'll just over-exaggerate it, but if it's puts to calls, it maybe goes to 5-to-1. So the ratio goes through the roof. Ratio goes through the roof. And we get this huge spike on the PC, which has been pretty flat up to that point. We get this huge spike on the PC, and that's that 5-to-1 ratio, which then reverses the market. Why does it reverse the market? Because obviously if you close off your puts into the bottom edge, the dealers don't need the short gamma, they don't need the short delta, the dealers buy all those stocks back, and obviously the price rallies from that price point. Price rallies from that price point. And that is fantastic. Well, the skew is a calculation, isn't it, based on the price of the outlying volatilities. It's part of the model. It's part of the volatility model, isn't it? So obviously, as people buy more and more and more puts, and they sell more and more and more calls, the outliers getting more and more and more busy, isn't it? Starting to get more and more busy. The worry is that they're going to start trading those outliers, and that means that you start hedging a lot more positions as quickly and aggressively as you can, and that creates the initial slippiness. And that creates the initial slippiness, which causes the sell-off. Now, obviously, if you've weaponized the gamma at that stage, then of course it gets even worse. But in most cases, it's not weaponized gamma. In most cases, it's just normal gamma scalp at the bottom edge.